All right, let's get another check on Salesforce. Those shares are falling post-earnings off the lows, but still down about 3.5%, despite reporting a beat on earnings and revenue for the second quarter. Joining us now is Luria from D.A. Davidson. Gil, is this a case of whiplash where Salesforce was getting criticized for being inefficient, but now the market's attention has turned to growth? And despite what Benioff has said about this being a year of AI, the growth numbers aren't quite measuring up?
They're really not delivering on either front. Their margins this year are going to be relatively flat. The quarter beat by a little bit, and they guided a little lower than consensus for next quarter. So let's call it an essentially inline quarter. And to Morgan's point from earlier, expectations were very low. So the fact that they disappointed even low expectations tells you where we're at. The growth is no longer there. They're not expanding margins fast enough. They really are stuck, and they really will need those activist investors to do what they did 2 years ago, which is to encourage the company to go out for that next level of margin expansion as it manages growth.
Well, I could argue, so let me give it a try, that there are very few legacy application powerhouses that are doing great out of the gate on AI. I mean, if you look at Adobe, it's been having trouble as well. Not at Salesforce, but ServiceNow had sort of already transformed itself. I don't know if you can really call that legacy in the same way. Is it perhaps a matter of adjusting to what this reality is, because these aren't hyperscalers, these aren't data center infrastructure providers?
That's right. We shouldn't have too high an expectations for the AI business. They are growing it well from a very small base. We're more focused on the bigger picture. We actually think that at some point last year, they were emphasizing the AI product so much that they dropped the ball on the 98% of the business. And that's why the growth decelerated so much. And actually, let me say that the silver lining in the results we're looking at right now is that growth in the two big clouds, Sales Cloud and Service Cloud, looks like they're stabilized. So that's the good news, is the big part of the business, the 98% of the business, is stabilizing. AI growth, we don't need to have very high expectations. They will grow that. What's a lot more important is how they manage their core business to sustain growth there. And then again, the big opportunity for Salesforce isn't to accelerate that revenue. That's going to be very hard. The big opportunity is that their margins are still 10 points lower than Adobe. They're 15 points lower than Palantir. They can do a lot better. And when the activists come in, that's what they're going to be focused on.
So how do they do that? Because they talk about it here in the release that they're on track for fiscal 26 to be a record year with nearly $15 billion in operating cash flow. They're boosting the share buyback program. We know they just made another acquisition with Informatica. How do they continue to boost those margins and boost that growth?
So first of all, not to make a lot more acquisitions. Informatica was fine. It was really struggling at the time Salesforce bought them, but they didn't have to pay a very high price for it. As long as Salesforce doesn't make other big acquisitions, it can tighten the belt on all the fronts, on all those OPEX items, the G&A, the sales and marketing, the R&D. These are all things that are at such a scale, they should be able to get a lot more leverage out of those lines. And that's how they're going to get the real earnings growth, is by doing that, not making dilutive acquisitions and then cutting costs across the board. CEO Benioff did talk about the fact that they're internally leveraging the technology to be more efficient on things like call center. That is the opportunity to double down on that in order to drive those higher margins.